بسم الله الرحمن الرحيم والصلاة والسلام على خاتم الأنبياء والمرسلين. This session is entitled Fulfilling Basic Family Dreams, the LARIBA Islamic Financial Services to own a car, a home, and a business. The first speaker is Mr. Mike Abdelaaty. I have two introductions for Mike, one that he jotted down and one that Dr. Yahya jotted down. And so I'll give you Mike's version. Dr. Yahya's, of course, Dr. Yahya's is much more praiseworthy, but since Mike chose to be modest, I will oblige him. Mike is the president of American finance house LARIBA since 1999. He comes from a background of commercial and wholesale banking in the U.S. as well as the Gulf, the GCC area. Actually, Dr. Yahya told me that his entire family comes from a banking background as well. He is married and has two handsome boys who are working here tonight, he says. So.
Okay, Bismillah ar-Rahman ar-Rahim. Today's agenda, if we can get the lights, please. I will be happy to tell you a little bit about American Finance House LARIBA. I'll tell you a little bit about our company, our background, our products and services, the key concepts that we use in delivering these products and services. I will go through an example of our automobile financing and then correlate it to our home financing product. And inshallah, we'll give a conclusion. American Finance House LARIBA is one of the oldest community-owned companies in the U.S. providing this type of financing. And I do underline community-owned. No affiliation to international investors, institutional or otherwise. We were established in 1987 by a group of community members who truly believed in making a difference to the existing RIBA financing programs. I wanted to provide an alternative that will make their children, their grandchildren prosper in a RIBA-free environment. We offer both types of financing. We are a licensed finance company, so we provide financing both on the consumer side and on the business or the commercial side. Our motto is, credit is a basic human right. What do we mean by that? It's a right like you have a right to breathe, to eat, to drink. You need to be able to finance your activities. So what we do, American Finance House, allows or facilitates members of the community to participate productively in the American dream. And that American dream is being able to buy a home, finance a business, buy a car, things of that sort. Our mission, quite simply, is to remove riba from people's lives. We do that by offering financing and investment services, and we serve and we endeavor to serve the individual's needs without regard to their social status, gender, race, religion, etc., without prejudice. Our goals are, number one, of course, to comply with the Islamic Sharia jurisprudence, as well as the rules and regulations of the United States. The two go hand in hand. Our second goal is community reinvestment. We facilitate the ability for our investors to put their money and have it utilized within the community that they live in, as well as job creation. We need to create the environment for our brothers and sisters to work in this type of field without persecutions, particularly for the sisters, hijab, issues of prayers, things like that. So we'd like to create that environment for them to be comfortable. We're located in Pasadena, California. In fact, just a block and a half from here. But we are very active on the internet and very accessible. We're sort of the .com company, LARIBA.com. We're currently registered to operate in 13 states throughout the United States, and we're expanding, inshallah. Our goal is to blanket the whole United States. The consumer services that we provide, I mentioned consumer and business. The consumer services we provide include homes, automobiles, and household equipment. And on the business side, we provide equipment financing, materials and trade finance, as well as business expansion. I must stress, though, that we are not a venture capital firm. We are not an investment company, so we cannot hold equities or things of that sort. We're very conservative. We're entrusted with the monies of our investors, and we care to make sure that we safeguard it to the best possible. We also provide an investment opportunity in order for, we cannot offer these investment finance the various projects without having the cash flow. So we offer the opportunity for qualified investors and institutions to earn a reasonable rate of return without riba while contributing to community development. The focus is always on community development. Our approach, and this touches on a question that was raised to me a couple of times today. What is Islamic financing? My humble answer to that, it's providing socially responsible financing, which is financing a socially responsible activity, providing financing an asset or a service, so it's asset-based, as well as tying the rate of return to the economic value, marking the market, the rate that you earn to the economic value of the asset that you're financing. We never start from a predetermined interest rate. If we look at our auto financing model a little bit, the background and the environment that we all see, there are strict laws and regulations covering the legal documentation and disclosures. The bankers in the audience and anybody who's ever been exposed to it, there's Regulation Z's, truth in lending, things of that sort, intended to protect the consumer. That's fine. We embrace that and we endeavor to comply with it. With respect to auto financing specifically, if you want to take a loan, you'll find that by going to your local dealer, the auto financing rates we all see in the newspapers are heavily subsidized. 1%, 2%, 3%. The banks are competing to offer that. But our community members who cannot partake in loans with riba are being excluded from that. They're forced to go to leases. When we've done our analysis of leases, we found that leases are more costly. As a matter of fact, the dealers nowadays are steering people towards leases as well because it generates a higher rate of return for them. So our financing model is a purchase financing based on a lease-to-purchase concept. We allow you to use the concept of a lease to be able to own that vehicle for a very comparable cost. The mechanics of our financing model, we purchase the automobile jointly with the client. We lease our share to the client. And at the same time, the client agrees to repurchase our share in the future. And given this agreement, we authorize the client to register the automobile in his or her name from the start, and we take a lien to protect our interest on it. How do we calculate the payment? Our payment calculation is based on two components. As we said, it's a lease to purchase. The first thing is the lease side of it. What is the lease value that's determined for this vehicle? And the client, since he did not pay the full price of the vehicle, if we're financing 80% of it, let us say, he has to pay us rent or lease based on our share. That return on capital that we've invested in that vehicle is called return on capital, and we call it RONCE. In addition to that, the client wants to purchase the car. He does not want to keep renting from us forever, so he repurchases our share. So in addition to paying a rent, he makes an installment on top of that to be able to purchase the car from us over the period of financing. The repurchase is called repayment of capital, or ROFC. And we have a proprietary computer program that we developed that will calculate a level payment for you, similar to what the bank offers. So you get a flat payment, $500 a month or $300 or $400, and it stays the same for the whole term of the financing, and it would cover those two components that we have. And I'll show you a little more. How do we calculate return on capital? As I mentioned, we never start from an interest rate. The return on capital is based on the lease or rental value of that automobile. We ask the client to go check with their local dealers, check with long-term rental agencies that are available. See how much a vehicle like the one he's looking for would rent for or would lease for the term that he wants to finance it. We do the same from our side. The two of us come together and discuss it and agree on what works, what's a fair rate of return. So, for example, if we're financing 80% of a vehicle, and we establish that the rental rate, say $200, the client would start out paying us 80% of that $200 or $160. That would be the lease component or the return on capital component. How then do we calculate the repayment of capital? That's the share that we've put in. Obviously, the amount that needs to be paid back is a function of how long the client wants to take to pay us back. The key that we mentioned is that we do not add on anything to the capital that we put in. If we've put in $10,000 in a vehicle, we get back $10,000, whether it's being financed over 2 years, 3 years, 4 years, or 5 years. How much is to be paid back? That we have a computer program that calculates that based on the term, of course, and the rental value. And I mentioned we can go up to 5 years on automobiles. For documentation, in order to comply with the U.S. laws and regulations concerning disclosure, truth in lending, things of that source, after we calculate the payment through our computer program, that level payment that I alluded to, we put it in a traditional amortization schedule to calculate the implied interest rate or the implied rate of return of that flow of payments, the $500 a month for 36 months. That rate of return we are required to disclose to the client. We have no problem. We disclose that to the client. And we prepare a note, a promissory note, and a lease to purchase agreement that is a proprietary agreement also delivered by the LARIBA. What are the benefits of our program? The client pays a rate of return based on marking the rate of return to the market, not a predetermined interest rate. And this helps in the sense that if you're buying a Toyota Camry, that rental rate is going to be different than if you're buying a Lexus 400. It's a fair and a reasonable way of doing it. It's not a flat 7% rate that a bank would charge or something of that sort. The additional benefit we have, because it is purchase financing, the client avoids the limitations of the traditional lease that a dealer would put on. There are no mileage restrictions. There are no certain maintenance schedules that are required to be done on specific shops or payments of that sort. And the residual payment, there are no residual payments. Our contracts are fully amortizing. So if you take a 4-year contract, at the end of the 4 years, you own the car. You don't have to worry about a balloon or a residual payment in the terms of those dealers. If we look at a numerical example, just to sort of hammer these issues in, let us take an assumption. We're looking at a vehicle that will cost $25,000. The client would like to put 20% down, which is $5,000. We're going to be looking to finance this over 4 years. And let us say the rental value that we both agree on, based on the checking of the client and our checking, is $200 a month. What then do we do with this information? We put this in our computer program, and it generates an amortization schedule like this. We're starting out with $20,000 that was financed. Our share is 80%. The client put down 20%. We finance 80%. We're financing over a period of 48 months. So the computer program will solve for a level payment, which you see here, $503. So for 48 months, you will pay $503. What's included in the $503? That includes the RONC portion. If you remember what RONC was, return on capital. RONC is, our share is 80%. We agreed that the rental rate is $200. So the first month he pays us 80% of $200 or $160. 80% of $200. If the total payment is $503, the difference will have to go to purchase back our share, or its ROFC, repayment of capital. And you'll see, because he's paid $343 in that month from our share, our balance will go down to the $19,657. The program solves the very next month. The rent that he's paying, the rental portion, is no more $160. Our share has declined, so it goes down to $157. And that share is basically the $19,000. It's calculated as the $19,657, which is remaining outstanding of our share compared to the original price that we purchased. It goes down all the way. You'll see the return on our capital, the rental that we earn, declines as we reach the 48th month. And of course, the payment stays the same. The balance that's outstanding will reach zero at the end of the 48 months. Incidentally, at any time during the contract, if the client were to come in and say, I wish I have some additional capital, I wish to buy your share fully at that time, no problem. We look on the schedule and see let's say you're in month 4, you want to pay off, the balance is $18,610. This is all you have to pay. There are no future rentals, no additional payments, etc. So this is our auto financing program. Our home financing program, I'm not going to go through the whole thing, but it works in an identical manner to the, thank you. Now the shoe's on the other foot. Huh? The home financing model works exactly the same way as the automobile. It is based on a fair rental value. This time, instead of an automobile, instead of the Camry or the Lexus, of the home. So we check the rent in the various neighborhoods that the client is looking to buy. The client does the same thing. We check real estate agents. We check with on the internet, etc. And we agree on a rate, a rental value. And we can finance up to 30 years with the help of our friends at Freddie Mac, as well as the down payment that we require can be as low as 5% now. Of course, if you have less than 20%, the industry convention is you have to purchase PMI, or private mortgage insurance. In conclusion, I'm not going to take the whole 5 minutes. In conclusion, American Finance House is a community-owned finance company. We are not a bank, and we're not an investment company. There are differences. We don't want to run afoul of the requirements for either. We are a finance company. We provide socially responsible, asset-based financing that is based, the rate of return of which is based on the economic or the rental value, the marking-to-market value of the asset that we're trying to achieve. And in our belief, this is the essence of Islamic financing. And of course, we have to strive and make sure that our dealings comply with the Islamic Sharia and the rules and regulations of the United States at all times. We have a website, www.lariba.com. All our services are mentioned on there. You can also apply directly online. And I will defer to the next speakers. Thank you very much, Mr. Chairman. Thank you.
Our next speaker is Mr. James Carey, who's the Director of Policy and Program Assessment at Freddie Mac. That position gives him responsibility for the development of affordable lending policies and products. He and his staff work with customers, including lenders and public and nonprofit organizations, to ensure that Freddie Mac's product offerings meet the needs of affordable lending communities. He's been in the financing and development of affordable housing area for the past 30 years, culminating in his association with Freddie Mac starting in 1993. Prior to joining Freddie Mac, he has served with profit and nonprofit organizations, including being Deputy Director for the Massachusetts Housing Finance Agency. He actually began his career as a real estate appraiser with the Department of Housing and Urban Development. So he's seen the real estate market from every conceivable angle. He serves as Vice Chairman of the Fairfax County Affordable Dwelling Unit Board. He holds a master's degree from Northeastern University in Boston, Mass. And his undergraduate degree was from Franklin Marshall College in Lancaster, Pennsylvania. He lives in Vienna, Virginia, with his wife and 3 children, aged 21, 15, and 13.
To start off with, as I said, I'd like to talk a bit about Freddie Mac, and we are a unique company. We're one of the few private companies that are chartered by Congress, and we really focus on one business. We have one business direction, one business model, and that model is to ensure that there is an adequate and constantly functioning finance system for housing in the United States, both rental housing and home ownership housing. Our relationship with American Finance House, LARIBA, is primarily on the single-family housing finance side, and both Saber and I, that's the area of the organization that we work in and we focus on, is single-family homes. We provide liquidity that supports lenders such as American Finance House's residential programs, residential finance programs. It's important to know that we do not originate any financing contracts. We do not deal directly with consumers. In a very real sense, many people in this room will not be familiar with that there's a Freddie Mac functioning throughout the country, and as I walk through my presentation, you'll see that we, as one of the leaders in the secondary market, have a very dominant role in ensuring that there is always available housing capital in the United States. And that really began for us in 1970. Our original role in 1970 was to provide an outlet for the thrift industry, the S&L industry throughout the country. At that time, I remember I was entering the workforce in 1970. There's only one or two people in the room here that do remember those days, but I will share that with all of us. And those are the days in which mortgage money would dry up and become available. Capital mortgages would be available in one part of the country and not another. And the savings and loan industry was the foundation on the U.S. financing system. And we were formed to provide an outlet for that industry to the secondary market, and that was our first effort, and we were established. I was entering the workforce then. And over time, that role evolved. And by 1989, we moved to become a privately owned stock owner corporation with a congressional charter. And we served all segments of the housing finance industry, from mortgage lenders, mortgage companies, the thrift industry, commercial banks, credit unions, a broad array of housing industry players. Our role evolved to link the mortgage origination market with global capital markets, and that's the role we play today. I'd like to share with you an outline of our role in that market and a little bit of a brief background on what we've done in the past year to put it in context. 2001 was a very busy year for us. We had our highest volume both in the single and multifamily side. And this was indeed a challenge to maintain this level of financing in the midst of an economic downturn, or some of us would call a recession, which we talked about earlier today. But we had our best year ever in spite of the economic downturn. And many of you have known, we had talked earlier about the cyclical nature of housing and cyclical nature of the economy in the United States. And traditionally, housing, unfortunately, leads the way into a recession and often leads the way out. In this recession, the housing finance system didn't enter the recession. And in fact, we remained strong at the beginning and stronger at the end, and had a very strong year. The mortgage origination volume in the year 2001 was $2.1 trillion. Our new business purchases during that year were $384 billion, which was our largest year. It was really driven by high levels of refinance, home purchases, and first-time home buyers entering the market. As we look back, there has been a revolution in the way that homes are financed in the country. Like other industries, mortgage market is being transformed by the tremendous impact of globalization and technology. And I will talk a bit about that in my presentation. Indeed, in many ways, financial services industry is at the forefront of these trends. I believe that America today, in fact, the housing system works so well, we often take it for granted. Most people take for granted the widespread availability, and Mike talked about this, of 30-year fixed-rate financings, even in the most volatile market. That's not the case in many other countries around the globe, and as we look back as recently as 25 years ago, that was not the case in the United States. 20 years ago, mortgage interest rates were twice what they are today, and the primary source of mortgage money was deposits in the thrift industry. The country was in the midst of a deep housing recession. In sections like the Northeast and the Midwest were rich in capital. I think a lot of you know now that I'm from the Northeast. When you hear my voice and you say, that guy's probably from New Jersey. If you go a little bit further up, this is a Boston accent. Sections like the Northeast, while the growth in areas like the West, in Pasadena and elsewhere in California, which were strong growth areas in the South, lack capital, and mortgage rates would be higher in the West and the South, and capital availability would vary throughout the country. That was the state of the country in the 1970s. A vastly fragmented housing finance system, primarily dependent upon the thrift industry. In the early 1980s, President Reagan convened a commission to look what could be done. And the commission really came to the conclusion that we could not have a one-legged housing system. We couldn't be totally dependent on the thrift industry. And Freddie Mac was developing through the 1970s and looked to organizations such as Freddie Mac to really be an important part of that whole system. And we were positioned to do that. We spent the better part of the 1970s standardizing how securities would be marketed to investors and how underwriting and loan processing and standardizing of that, so there was a national standard for underwriting and security structuring, and to develop the capacity to originate and close and securitize loans at a massive volume. And we fit very well into it. We were well positioned by the late 1980s when we moved to a stockholder-owned corporation. We moved to an organization that really set up an entirely new system in the way that loans and mortgage financings are processed in the country. And this slide describes that in some detail. We really have two ways of financings. One is a securitization structure in which we purchase loans for cash, and the other is a securitization structure in which we swap loans for participation certificates. A key to this, and underlies a lot of the discussions this morning, is that a financing system evolved in the United States that is highly competitive, transparent to consumers who participate in it, and has standard business terms that all parties to the transaction can understand. And that rings through to a lot of the things that we discussed this morning in terms of what we're looking for fairness in a relationship in a financing. All parties to the transaction should understand its terms clearly. There should be strong competition and fairness of rates, that competition creates those rates in standard business terms. And the outgrowth of the system that is developed in the country really leads us to that, where a consumer will pick up a paper in the morning and know what the business terms are. There will be the same business terms that I will use in closing a loan in Virginia as you would use in closing a contract in California. But getting back to these presentations, the securitization structure, what we do. We will buy a financing contract from a lender throughout the country. We can buy it in as small as 1 loan or 5 loans. And under that structure, that loan, that financing contract, the lender will receive cash for it. In the other structure, the cash approach is about 20% of our business. The other structure is a structure in which we will buy loans and contracts in high volumes from lenders throughout the country, and the lender will swap that loan for cash, which is a AAA security. We as Freddie Mac will guarantee timely payment under that loan to the eventual investor. That becomes a very liquid transaction that can be used throughout to either sell that security and create more cash, more liquidity, or for the financial institution to hold it on its balance sheets. That sounds very confusing, but here's a graphic illustration of it. Effectively, a homeowner enters into a financing arrangement with a lender, as you look at the right side of the screen, closes a transaction, and in the loan and the payments on the loan are remitted to the lender, who in turn remits those loans to Freddie Mac. And we will send cash back to the lender, so the lender's whole again. The lender can then go on to the next financing transaction. We then take thousands of those loans and we'll pool those loans into a security that we as Freddie Mac will issue to an investment bank, and use an investment banker to market that in Wall Street. And it will go full cycle to bring Wall Street to Main Street, is the term that we use, that the transaction is cyclical. Loans are being purchased by lenders. Lenders are selling us the loans. We're remitting cash to the lender. And then we will pool all those loans in a security and create a cyclical structure. The next is the securitization structure, which is about 80% of our business, a little bit of a hybrid of it. Rather than Freddie Mac being in the position of issuing the security and marketing and through an investment bank at Wall Street, we will take the loans and swap those for a security with the lender, who will then convey the use of security and either hold the security on their balance sheets because there's less capital required to be held against that security, or they will market it in the secondary markets through an investment banker and again create cash for the financing market. That's really the nuts and bolts of Freddie Mac's role. We're not a direct originator of any financing in the marketplace. Our customers are American Finance House, Wells Fargo Mortgage, and the mortgage industry in general. And I'd like to share with you a bit about what our vision of the future is. And it's really bringing those capital markets to Main Street and using technology and other vehicles to drive down the cost of housing for consumers throughout the United States. And the vision is to constantly find better ways to appeal to investors, create different types of financing structures. We currently have securities that are marketed in euros in the European market. We market aggressively in the Far East and in the Middle East. So we're opening up the global financial markets to the needs of consumers in the United States. With all of that, we're really creating, through our automated underwriting systems and technology advancements, a system in which there'll be really one link between the consumer and Wall Street and the ultimate investor, whether that be a pension fund in New Jersey or Middle East financial institutions. By attracting the global capital markets and using new technologies to deliver it to mortgage lenders as efficiently as possible, we're reducing mortgage costs and saving families billions of dollars. Where we're going in the future. American families need an additional $6 trillion over the next 10 years to finance housing needs in the country. And we will play a vital role for generations to come to open doors to home buyers who are more likely to be low-income, minority, immigrant borrowers, and individuals eager to achieve the American dream. And Saber will talk a bit about that in his next presentation. It's a key business goal and a business objective for us in this mission. As part of that, in developing our relationship with American Finance House, we recognize that there are barriers for many Muslims in achieving home ownership in the U.S. And we really see it as a key aspect of our business is to find ways to remove those barriers and to work with American Finance House, LARIBA, and other organizations in the country to find ways to complete our program and make them available to all of residents of the United States and ensure that everybody has full access to the best housing system in the world. I've really enjoyed this. It's been a great opportunity. I hope you found me as entertaining as you would if I were the real Jim Carey. And it's been my pleasure to be here today. Saber will continue the presentation with this slide, and we'll be available to answer questions at the end of the presentation. Thank you.
Assalamu alaikum, and I'm really pleased to be here today. Part of my role in today's presentation, even though Jim says he's part of my team, I don't know whether he's part of my team or I'm part of his team, so he's largely told me what I should say and what I shouldn't say in today's presentation. Let's talk a little bit about home financing and the importance of home financing in the U.S. economy. Home ownership is the fabric of the American family. It helps build very vibrant community. It helps build personal wealth for all Americans. Housing is a major sector in the U.S. economy. And even though we've gone through a 12-month recession since March of last year, housing has been one of the strongest part of the U.S. economy in the last 12 months. This has been largely driven by a historic level of low interest rates that are available to finance homes in the U.S. market. Let's look at the value of homes in the U.S. We estimate that the value of homes in the U.S. to be around $12 trillion, of which about $5.5 trillion has been financed. But what's most interesting here is in the last 4 years, as you can see, American families have gained over $2 trillion of home equity. That is appreciation in the value of their homes, and that is really contributing to their growth in their personal wealth. This trend is expected to continue. We expect, as Jim indicated, that by the year 2012, the home financing industry will be close to $11.5 to $12 trillion. And a lot of this growth is going to come from two areas. One, house price appreciation, which has been relatively strong in the last 4 or 5 years, as this chart indicates, as well as new homeowners coming into the market, so the need for new housing stock. All of the reports that you see about home building and resale support the current sort of growth and potential for the home market, housing market. The next slide kind of gives you a little bit of indication of where have home financing costs evolved to. And for purposes of illustration, we put 1963 here, where the rates for home financing were a tad below 6%. And here we are at the end of 2001, and we're tracking home financing rates in a tad higher than 7%. So over this entire 30-year plus period, the cost of home financing is coming down. There is a reason for this. Part of the reason here is there is a different way that the American economy is financing homes today that I will get into in a little bit. Home originations, Jim mentioned, last year was a historic year, $2.1 trillion in new home financing. We expect this trend to continue. This year, we're looking at a $1.4 trillion home finance market. And for the rest of this decade, we're projecting between $1.2 to $1.4 trillion of new homes originated every year. What I'm leading to here is that the home finance industry is expected to be very strong and vibrant as far as the U.S. economy is concerned, not just now, but in our projection is for the next 10 years. Home equity, again, is going to be a significant component of how families accumulate wealth. And a large percentage of the growth that we see at Freddie Mac is going to come from minority families and immigrant families who are largely underserved in today's home ownership process. And we'll get a little bit into that in the next couple of slides. Today, the home ownership rate overall is about 68%. So 68% of American families own their own homes. When it comes to minority groups, that percentage is a little below 50, or around 49%. Over the next 20 years, minority families will be 36% of the U.S. population, up from 25. In addition, we're expecting 10 million new immigrants to come to the U.S. So this gives you a little bit of perspective on what the average home ownership rates are across various demographic groups. You know, the highest is with the white Caucasian group. Home ownership rates are in the tad over 73%, followed by other minorities, and we've broken down African Americans and Hispanics. Now let's talk a little bit about the U.S. home financing market. Home ownership opportunity for devout Muslim families have been limited. Much of the reason for this is because there are the financing has come from essentially 3 or 4 sources. 1, from personal savings. 2, from financing available through individual investor groups. 3, some cooperative arrangements, and some limited portfolios that banks have made available to finance home that meet the financing needs of the Islamic community. The third aspect that we are tracking about the Islamic community is that it is a high population of both minority and immigrant families. And that's one of the reasons why we're looking at this segment of the market with a lot of interest, and we're trying to figure out what is the best way to promote home ownership rate within this market. So what are some of the limitations that we see that are present in the Islamic home finance market? The first one that we see is a lack of steady flow of capital coming into this. To finance a home, you need a fair amount of money. The average financing that we do at Freddie Mac today runs about $160,000. That number is significantly higher in the California market. Somewhere in the neighborhood of $190,000 to $210,000 is what a amount of financing is needed. This is quite a large amount of cash that is required for this transaction. Although the home financing system, as Jim outlined earlier, is one of the most sophisticated in the world, there is not a good understanding of contracts that comply with Islamic religious beliefs and standards and are also compatible with U.S. laws and regulations. So part of our role at Freddie Mac is to start reviewing these things and get some solutions from an institutional perspective into the marketplace. And last but not least, secondary markets. Freddie Mac is a part of the secondary market. Provides over 50% of the financing for the U.S. home market. And by and large, until we had our announcement a year ago, by and large, the secondary markets were not engaged in providing some of the financing that's needed to provide homes to Islamic borrowers in the U.S. So we've realized some of these gaps, and we are in the process of trying to figure out what are the best ways to help remove some of these barriers from the Islamic finance market. What we are hoping to provide is very streamlined and cost-efficient way that the Islamic financial institutions can access our funds, low-cost funds, to finance homes. And we also want to make sure our customers, as Jim pointed out, we are not lenders, we are investors. So our customers are American Home Finance, Wells Fargo, and the like, and our goal is to be able to provide them the necessary instruments that they need to be able to provide financing to the Muslim buyers. So the three areas that we're focusing on. One, product development. There's a lot of discussion about this this morning, so I won't get into a lot of detail with that. But Freddie Mac is actively engaged with a lot of financial institutions, our funds, low-cost funds, to finance homes. And we also want to make sure our customers, as Jim pointed out, we are not lenders, we are investors. So our customers are American Home Finance, Wells Fargo, and the like, and our goal is to be able to provide them the necessary instruments that they need to be able to provide financing to the Muslim buyers. So the three areas that we're focusing on. One, product development. There's a lot of discussion about this this morning, so I won't get into a lot of detail with that. But Freddie Mac is actively engaged with a lot of financial institutions to develop the right products that meet the needs from a Sharia perspective, religious perspective for the Islamic consumer, as well as meet the secondary market or U.S. regulations for us to purchase those. Once these products are developed, we are providing liquidity to this product by purchasing all of these loans from our customers like American Home Finance, and so that they have the ability to lend this money back. A third area that we have started focusing on is, and we have been for a while, is somebody in a previous presentation talked about sort of affinity marketing or niche marketing. We believe that there are new lenders that are needed to serve this community, and that Freddie Mac is very actively seeking companies that have the right infrastructure to approve them as seller servicers, so that we can have new customers at Freddie Mac that will provide this financing to the community. I told you earlier that I was going to talk a little bit about the home financing, sort of why banks are pulling out of this business. This slide would suggest that 50% of the mortgages today are financed by the mortgage-backed securities market, which Freddie Mac is involved in. If you look at the financing contract in the U.S., they're now 30-year type contracts. And the 30-year contract, and I showed you a slide that the 30-year return has consistently gone down over a long period of time. So banks or thrifts have difficulty matching their assets and liabilities when it comes to home finance. So what's happening here is most of these banks and thrifts are turning to the secondary market to help sort of provide the mortgage product that's needed for the consumers and get the liquidity out of the secondary market. And we see that this trend is going to continue, because unless the mortgage contract changes from a 30-year to a shorter duration, we see a continued trend from American banks and thrifts to sell more of their assets into the secondary MBS market. Since Jim and I were here last year, we had announced the first $1 million purchase from American Home Finance, LARIBA. I am so delighted to report that at the end of 2001, in just a little over 10 months, that number was $20 million of new capital coming to Muslim families through American Home Finance. And we're very proud of it, and I hope you are as well. And there's a lot more, as Dr. Yahya and Mike Abdelaaty keep telling us, that there's a lot more loans or financing where this came from. So we're very excited about that too, Dr. Y.
You know what I'm looking for, right?
Yes. The two challenges that we see in this market, and these are areas that we are trying to help solve, and we need help from the community at large. One is standardizing the products. The best way to leverage the secondary market is to create transparency and come up with products that can be offered by multiple lenders so that the whole community is going to benefit from it. So we need some help in standardizing that, the products. We also think that there are new financial companies that are needed in this arena. Companies that are specifically targeted towards serving the Islamic home buyer, as well as that can bring both scalable solutions, because mortgage, the industry is a fairly sophisticated industry. It's a large industry and a very competitive industry. So bringing scalable solutions and infrastructure is going to be a key for those that will be successful here, particularly the new firms that are coming into this business. And we're committed to working on both these dimensions with the community. So in conclusion, the cost of home financing is one of the lowest today in the history of the U.S. And we believe that this financing needs to be made available to more and more consumers, particularly the underserved Islamic families. Secondly, home equity, or the growth in house price that results in individual wealth, is an extremely strong component of wealth accumulation in the U.S., and it is imperative that the Islamic community at large, Islamic families at large, take advantage of this. We were talking about some of the stock or equity options. Here is the real estate alternative that can be equally attractive. The third area is the secondary markets are key to liquidity here. This is a long-term asset. The best way to finance the asset is not on your balance sheet. And if you can take a page from the American banks, that's exactly what's going on here. The idea here is to attract and leverage the secondary market, because the financing could be unlimited coming from the secondary market. And last but not least, product standardization and investment in infrastructure are going to make the difference between the winners and winners, because everybody will be a winner here, because you'll be providing a new service. But the opportunity as we see it is tremendous, and these are the two areas that we need to see some new investment in for this market to be able to realize the full potential of low-cost capital in the Islamic finance market. Thank you very much.
Thank you very much, Mr. Salam. We're actually behind schedule, even though every one of the speakers on this panel has been within his allotted time. So I think this is commendable. What would the organizers like us to do? 5 minutes of question and answer. Please.
This question will go to Mr. Mike Abdelaaty. You did a good presentation about the home lending. I would like to take a look at the dark side of a loan. Let's say you have a client and he fails to make a payment on a house and he moves out from the house, so he's not benefiting from the house. What will happen in this case? Can you foreclose? Will your runs increase, or will you sell the house and return the equity?
We really run a fine line. We have a dual fiduciary responsibility to our investors as well as to our clients. And that's really what differentiates the Islamic banker from the traditional banker, if you will. Our goal is to work with you, to help you get through the difficulty that you have while maintaining the security of our investors. So what we do is there's a concept of forbearance. We try to work with you and wait, if at all possible, until you get through the difficulty that you're in. If that does not work, perhaps another type of financing is more applicable for you than the one you're in. For instance, if you're looking at 15 versus 30, etc. A third situation is if you're looking at, we do not increase our RANSI because you did not pay. So if our RANSI was $200, if the rent we had agreed on $200, that's in the case of a car. Of course, for a house, say $1,000, we do not increase it to $1,100 now because you're not paying. But worst case scenario, we have to divorce. Of course, we would look at the foreclosure on the property. We would encourage you to sell the property first. If you're unable to sell it, we would foreclose on it. Any excess proceeds that are realized, of course, we return them back to the investor.
The investors are also not necessarily interested in foreclosure. So we are working very, very hard to come up with tools and ways where we can help consumers restructure debt and provide another vehicle for them to be able to retain their property. So this is the worst case scenario from both perspectives.
My question is, when a traditional bank, when they look into mortgage application, they look into the applicant credit history, and sometimes that affect the rate that they give to the applicant. Well, do you look into credit history, and does that affect the RANSI when you give a loan mortgage?
We do look at credit history, of course. We have to determine the credit risk. But the RANSI is primarily determined by the rental value of the property. We may look at the overall risk profile to see, do we want to get into this transaction? But it's not a formula for, say, if your credit score is this amount, then this is the minimum RANSI we would require, whereas if it was this, then it's a higher RANSI. RANSI is always derived from the fair rental value of the product.
We have time. I recognize there were 3 questions. Can we take 3 more, but give them really short? And
my question is, what is the LARIBA's nature of transaction with Freddie Mac? Do you deal in interest? They buy your loans, and what is the relationship of the transactions over there?
Their relationship to us, they're investors. We structure the transaction in the manner that I described for the automobile financing, using the rental value, calculating the monthly payment, using our program, negotiating with the client. From the calculated payment, we derive the rate of return that's generated. We show the credit profile of the customer, how long he's been employed, all the background of the application to the investor, and say, this is an opportunity we have for you to invest. This is the rate of return that's generated, and they have the option of accepting it if it meets their guidelines, or they do not. So in a way, you can look at us as a money manager or mudarib for investments on their behalf. We do not borrow from them. It is not a lending relationship.
But that's absolutely, we are not, Freddie Mac is not dealing with the consumers directly. We are working with our partners like American Home Finance, and we jointly agree on the types of products that will be eligible for purchase at Freddie Mac. And once the product is originated, that's when we participate in that product.
I'll try and make it brief. I guess the lease with buyback option, I think, is a big improvement over the bay' bil-ajal, or I'm not sure what's it called, murabaha. I think it's a big improvement, but I think that really applies for short-term kind of purchases. Not really, I don't think, applicable to long-term investment type of like business financing or home financing. I think most Muslims consider home financing not as a minor purchase, but really as a long-term investment. So the question is really, when will we have equity-based financing for homes? And what is the problem with that in terms of U.S. bank laws or whatever? And when is that going to be overcome, or when will it be possible?
I take issue with your claim that it's not appropriate for long term. As a matter of fact, I mean, lease to purchase is applied to long term. It doesn't get any longer than 30 years. That's the length of a government bond. Even the U.S. government doesn't issue anything longer than that. But yeah, exactly. Well, still, it's debatable. But no. But the point of equity sharing, the problem is, yes, you cannot be a bank and have real estate on your balance sheet. It's a risk that financial institutions, especially depository institutions, are forbidden from carrying here in this country. So if you're licensed as a bank, you cannot carry the property. But from the point of view of the home buyer. If you're in a lease to purchase, basically you're agreeing on what to pay based on the rental value. All capital gains are yours, whether you refinance, whether you opt to purchase it now, or you run the lease to its natural end. All capital gains are yours. Why would you want to share that with the bank? I mean, it was just a bad economic model written in the 1960s that sharing is better than other forms of financing. We should probably end. There was one question here I had recognized earlier, so maybe we should have that one and then wrap up the session, please.
The question I have is to you, Mike. How would one explain to a novice, as it were, when he makes a loan with LARIBA, that he signs on a paper with says interest on it?
Basically, the way we calculate the payment, and we're required by law to disclose the rate, so this is something we have to do. But we calculate it based on the rental value, as we mentioned. The rental value that's agreed upon, we take the rental value, the term that you want to finance, we put that in a computer program that calculates the level payment, the $500 in the example that I was showing, the $503. After you've derived that payment, really any financial calculator, you can calculate the internal rate of return, that interest rate that generates from financing $10,000 and ending up with 48 payments of $500 a month. That rate of return, that it's an economic formula, that rate of return we are required by U.S. laws to disclose as an interest rate. So it becomes, rather than interest, it's not the term, and Professor Mahmoud al-Ghamna has always talked about that. It's not the term, but it's the nature of the transaction. The lease to purchase concept, the basis for calculating the rate of return on the asset, on the rent, and then backing into a rate. That's the rate that we're required to disclose to the client, and we're required to put it in the transaction documentation. We use the traditional transaction documentation that any traditional bank uses, but we supplement that with a LARIBA agreement that explains, as a Muslim company, we do not intend to deal in interest. In fact, the rates that are calculated are required by law to do so, and we use that rate. The rental rate that's boiled or backed into a rate of interest is what's put in the note to denote the return that you're paying, the rent. Instead of paying $200, you're paying X percent. So it references the rental value that you're paying. And another reason we do that, standardizes the documentation. It makes it more attractive for investors, as well as it helps the homeowner in the event if you want to get out of the transaction, or if you have to go to court, you show your documents. The law fully protects your rights and our rights.
Should I guess Dr. Yahya wants to make a remark? Or
just want to add to one little conceptual statement to the spirit of what we're doing. We're not just doing this to prove that we are right or so on and so forth, but we're trying to bring in the spirit of what we think the Prophet, may God's peace and praise be upon him, brought with the idea of riba. Now, if we calculate the internal rate of return and it comes out to be 10% in a mortgage market which is 7%, that means it's a great investment that we can go in together with the person who's buying the house. So we're going to get 10% on our investment. It's a great investment. So what we do, we go to Freddie Mac and say, well, Mr. Freddie Mac, online, we got this client, and would you like to invest, and what's your expected rate of return? Suppose Freddie Mac says, well, I'm very happy to live with 7. And we go to our client and unilaterally tell Mr. Client, because we don't want to put you in harm's way and make it difficult for you, we are going to unilaterally reduce that rent that we agreed to, so it will not be costly and will be competitive with the rest of the market. The second scenario is that your rate of return on investment is 6% in a mortgage world of 7%. That means from an investment point of view is that you have a marginal kind of investment. And we tell the client, Mr. Client, we think that you can go back to the seller of that house and you can squeeze out $10,000, $15,000 because we think that this is an overpriced house. And guess what? We have done it at least 3 times in different places in the country. And they went back and we told them what is the fair market value of that house based on what the rent is of this particular property in this particular neighborhood. Now what's the third scenario? And that's very fascinating. And this is really what captures the spirit of this whole idea of riba. And that happened every time we went to Northern California. You go to Silicon Valley and you get the rentals and you get the value. As a matter of fact, in Silicon Valley, Hatim comes from there. You rent, you buy a shack for about $1 million, right? Hatim, about 2 homes, two bedroom. Now, you go to the riba banker. He doesn't care if this thing rents for $1,000 or $5,000. All he cares about, how much is your down payment? He sends his appraiser, and we do too. Now the appraiser, what does he do? What does the appraiser do? He goes down and he finds out how much are the homes selling in this neighborhood. And if you have a bubble market, you'll be the next sucker on the block because you'll be suckered into the higher price. Now the banker doesn't care as long as you have a good income, putting down 20%, and as long as you sign the agreement, starting with the interest rate. We care. And that is what brings the whole spirit. Because we take the rent, plug it into our model, and come up with the expected rate of return. It comes out to be 1%. We tell the client, Mr. Client, we think it is better for you to rent now. There is a bubble in the market, and this bubble will burst, and it's bursting in Northern California. Somebody is trying to bring it up, but believe me, it's going to burst in Northern California. And when it comes back to what is fair, we suggest to the client, back off. Don't waste your money, and we recommend strongly not to do it. When we explained that to Freddie Mac, not Saber Salam only, but Ron Kaplan and so on, they said to us, and Jules said, you got to go and register this idea, patent it, do something about it, because nobody has ever done it this way. And we think this is the spirit of Prophet Moses, the spirit of Prophet Jesus, the spirit of Prophet Muhammad in the whole idea of prohibition of interest and excessive lending. Thank you very much. Is this clear? Yeah.
I guess we're way behind schedule, so I think this session is adjourned, and because locals haven't prayed Asr yet, so this is break time.
Okay.